that you need more snare?
Oh man, welcome to Freightonomics on a rainy Thursday here in Chattanooga, Tennessee. I'm Zach Strickland, head of Freight Market Intelligence at FreightWaves. Anthony Smith, chief economist here at FreightWaves, and we are here to talk about the current freight market economy as well as the macro economy and combine those two things together and send you on your way so you can make sound business decisions based on some data insights. So, Anthony, we just had GDP come out.
Yes.
And we were just talking about it a little bit. What was it, and what's your takeaway?
Yeah, it was 1.1% real GDP. The big thing was some of the detraction or downward movement came from investment. So we saw a downward movement within the report coming from a 12.5% drop for gross private domestic investment.
Is that a shock, considering?
That's much of a shock.
Like financial investment down, that's no big shocker. So, today's show, we're going to talk about the flaw in looking at financial figures, how they can be misused, and operational data, how it can fill some of those gaps and be actionable. Because the big storyline over the last couple of years has been inflation, right?
Yeah.
So how can you look at dollar values at face value and make decisions, like soundly?
It's almost
tough.
like when we look at say, for example, the retail sales report, not adjusted for inflation, and then you see, hey, retail sales are going up, they're going up, they're going up, but it's not adjusted for inflation, and then next thing you know,
right,
you see this huge dip down in gas stations only because you see on the gas CPI that it also declined, like 3, 4, 5% over the same time frame. So it's just looking at the data and understanding what's really being told here in the story.
Yeah, and it's not just a factor on the sales revenue gen side, it's also a fact on the cost side as well, something that a lot of trucking operators and transportation providers are overly familiar with, as well as numerous companies who have had lots of cost input increases. We talk about the PPI versus CPI last week's show, and the fact that a lot of companies have not built their margins back up to where they were prior to the pandemic, which means that inflation is going to continue even as some of those cost inputs are seeing downward pressure. Yeah,
there's so many, I think, levers that will have to be pulled to really kind of shut down inflation. We think about that instance that you just laid out. Mm-hmm. We think about, for one, the value of the U.S. dollar. The U.S. dollar going down, that's going to make imports more expensive. Now, it makes maybe some of our exports more attractive to the rest of the world, but when the rest of the world, like Europe, is not doing so hot, that's not going to be a big draw for them. So we're looking at the drivers for inflation. They're still going to be well and still very much active. The other big thing, of course, is say we get into some recessionary trends that not even the Fed can deny.
Don't say that word.
They tried to change the definition on us. Remember we had
I'm going to censor you.
No.
Censored.
They tried to change it and then say now we see some recessionary trends. What can the Fed do? What can the government do to stop that? They can do some quantitative easing. And
they can raise interest rates.
They can manipulate interest rates. But the big thing is when they start doing that quantitative easing or they lower interest rates, both of those things are inflationary building. So if they do not kill inflation, especially that sticky inflation that is existing right now, the cure for the recession could be inflationary building itself.
Wow. What a tangled web we weave. So let's get into it, Anthony, before we get into some earnings that I obviously want to get into, but also that freight market update.
Yes, right.
We're ready to go.
Counting down in 3, 2, 1, go.
All right, I told you I was going to lead off with the outbound tender volume index. If you aren't familiar with this, I'm beating you over the head with it like a country song on the radio until you get it through your head. This is our demand side indicator for freight demand. It is counting the total number of tenders going from shipper to carrier. And we see a little bit of an uptick there, Anthony Smith. In that last week, we've actually seen a pretty decent little increase in the total number of tenders moving through the United States. This is very short-lived, certainly not a trend as of yet, but towards the end of the month of April, it's very unusual to see this level of uptick in the tender volume index, very unseasonable, if you will. And it is the highest level, highest value we've seen almost all year, except for that little entryway out of 2022 there around January when we have a little bit of this bubble of tender volumes, but a decent increase to watch nonetheless. So what's it doing to capacity? Are we seeing any changes here? Let's look at our next chart to see Outbound tender rejection index, completely unaffected, does not care. So any increase in demand, which has been relatively mild, to say the least, over the last week, has nothing to do with increasing tender rejections or tender rejection rates. It's not influencing capacity in a strong manner. Tender rejection rates still close to historical lows, 2.78%. And it's arguably, going to make things tricky, and the longer it stays under 3%, this means that carriers are simply just auto-accepting everything they can get their hands on. So last but not least, let's look at the VOTRI here, along with the refrigerated tender rejection index and the flatbed tender rejection index. So splitting these into the three main trailer types, flatbed there in green, still showing resilience, Anthony. This is shocking to me that flatbed has been so resilient, and refrigerated there in blue and van both hitting ground level. Normally we see refrigerated start to spark up at this point, but not so far.
Yeah, that flatbed rejection, definitely intriguing.
Yeah.
I think, of course, we still have a historic amount of homes that have been started but not yet finished. So
is it a bubble? Are we in a little bit of a bubble coming out of the pandemic on the construction side still?
There is a substantial bubble of homes still under construction, for sure. And on top of that, there's a whole bunch of homes that have been authorized but not started. So those can, I think, really kind of be canceled and kind of wiped away if we don't see more momentum pick up. And of course, an existing home market, still limited inventory overall.
Yeah, and flatbed spot rates have been remarkably resilient throughout the spring here. And of course, seasonally speaking, that's not unexpected. But compared to refrigerated and van, it's in its own island. Yeah. Normally, these modes tend to move together. They have similar experiences. Flatbed has been arguably disconnected since the beginning of the pandemic from refrigerated and van due to the type of freight environment that they operate in. You've got construction and industrial manufacturing very disconnected from the consumer. Right. Very upstream versus downstream process. And flatbed being, if you're a flatbed operator, that was the right thing to do right now. Because they were also the least, like I said, during the pandemic, flatbed wasn't as in demand as van and refrigerated was due to the type of goods moving, and flatbed didn't get the same capacity growth.
Yeah, so I was going to say, back if you look at 2019, 2020, it was almost flipped, where we saw,
totally flipped.
No one wants a flatbed, no love for the flatbeds, and now we're seeing flatbed really kind of getting all the activity, especially as you mentioned construction. Manufacturing construction still a thing. I'm expecting some of that investment, as we've seen from the GDP, to really start to wane as we get further and further into the year. But right now, there are just so many projects still, I think, in process.
I think are we a little addicted to the speed that information comes? We kind of think that everything reacts as fast as it's communicated.
100%.
And that's just not the case with real world. I mean, you think about these projects, these construction projects. You don't just say, I'm going to go build a house today. Yeah. And then start building the house, and there it goes, foundations in. No. Having been a part of that process myself, that's a year and a half, flattening the land, laying the foundation, getting framing.
Drawn out process.
You got all sorts of stuff going on. So why would we expect things to just change on a dime like that?
Yeah, and there's no way that it can. And the other part of it that goes into it is, say you're not building a house, say you have your own home. Something that really kind of, I think, picked up steam throughout the pandemic was all the home projects. Your DIY, I'm going to renovate, I'm going to get some carpenters in here, I'm going to knock this wall out, get that open floor plan I always wanted. Right now, I'm expecting that in those existing homes, the remodeling segment, I think, is going to be a little bit more muted just because of consumers' financial positions. And maybe you see a little bit more ambitious DIY, but I think we're going to see a little bit less momentum coming from some of those, I would say, home construction projects that we would have seen over the last few quarters.
Yeah, I mean, when interest rates go up, prices go down.
Yeah.
I mean, that's kind of the relationship. Well, let's break into the news and nomics. There's a few stories I'm going to zip through, and there's a few I'm going to stick on today. First one, leading off the week, Todd Maiden covered the CAS data, saying that, basically transportation expenditures down 12%. Year over year. This is not a shock. Did we see the OTVI? It's way down year over year. So expenditures should be down year over year as well. Shipments showing 4% down year over year. And, versus the last couple of years, actually still down. Yeah. Two years in a row. So freight recession. There you go. I mean, it's showing the line haul index, which measures also the amount of truckload line haul spend, down 9.6%, indicating that rate decreases are a thing. I want to pull up the contract rates here from our own data, which correlates pretty well with the CAS index there. Van transportation contract rates there in the white, and of course in the blue, we've got our spot rate index, the NTI, excluding fuel costs above $1.20 per gallon to make it more comparable. Both of these indexes are down. The van contract rate index down 15.7% year over year, and the spot rate index down roughly 25% year over year. So spot rates down faster than contract rates overall. And it looks like here in the last week or so, we've actually seen the spot rates flatten out. Tony Mulvey and I were talking about this earlier today on the Spot, and contract rates appear to be a little bit stickier than I would have expected, considering the amount of spread between those two.
Yeah, that spread is something I think is interesting, because we would have almost expected it to come down a little bit faster, but it is in that downward trajectory for sure, but just not accelerating in any way, I don't think at this point. But with that ongoing downward movement for the spot rates, it leads me to think that there's going to be continued downward pressure on contract rates going into mid-year.
Yeah, and Joe Antoshak wrote an article about, so this is what the bottom of the freight market feels like. Basically, we do a survey, and our research team does, and they do a fantastic job at that, kind of asking for people, what do they think is going to happen next? And carriers have gone really negative. They're basically very doom and gloom at this point. And you kind of over-apply your current experience to the future. I actually think they have more reason for optimism than the shippers and brokers who are optimistic about the last half of the year. And they're still, I say optimistic, but relative optimism is the case here. But carriers have gone deeply negative. Shippers, brokers, slightly positive for some recovery next year. I think carriers, you're bottoming.
Yeah.
This is the carrier segment feels things faster and quicker than all the other sectors, and therefore that market tends to correct first, and then everything else comes later.
Yeah, and I mean, when you're looking at the other side, we talked about the shipper side. They have their headwinds really starting to pile up for them when we start looking at the latter half of the year, especially when looking at the state of the consumer, and that potentially really starting to come a little bit more undone. The amount of investments really being able to go in, and then of course margin pressure. I think there, and then of course when you think about what the Fed is going to do. So there are just so many, I think, headwinds on tap for shippers that really looking at the latter half of the year should be very concerning.
Yeah, macroeconomically speaking, there's a ton of stuff that says things aren't going to get better for the consumer, and the consumer drives our economy. So from a freight perspective, tender rejection rate's 2.7%. Zero's as far down as it goes, and theoretically, we really can't hit that. So spot rates have already kind of crossed the threshold of being below cost. Contract rates can arguably get lower. Freight demand can get lower, but it's not going to feel like the transition we just had. It may not be the actual bottom, but it's not gonna feel that much different than it does right now, period. And I think that's the big takeaway for me here. So
also, I have to mention, if I'm looking down from time to time, we are streaming on LinkedIn if you're watching live. So if you want to jump in on the conversation, have a question for Zach and myself, have a hot take, join in and be a part of the show.
Yeah, so I want to briefly mention this article from Rachel Premack, why most of America's 2 million long-haul truck drivers aren't unionized. If you do not know the freight market and transportation and trucking, I highly recommend you read this. This talks about deregulation and how trucking has evolved to become the commodity that it is. Deregulation, what do you think about when you're talking about regulated things like oil markets, commodities? Trucking, same thing. They knew that if they deregulated it, it would get cheaper. And that would put downward pressure on inflation coming out of the 80s or the early 80s when we were at record levels of inflation, just like today. We've already seen, like you just saw with contract and spot rates, rates are coming down. We are seeing deflation in transportation because of the fact that it's deregulated. Regulation would have increased and kept those costs in alignment, making inflation worse.
Yeah, and when looking through the article, thinking about how there was even some processes where if one company or one carrier wanted to kind of say, hey, I can bring this price down for this rate, other carriers would have to approve that decision. And that almost sounded a little cartelish,
And she uses the term cartel in there.
Yeah.
Very interesting article nonetheless. So we did have a few earnings. One of them specifically, and this is what's going to drive the discussion today. Old Dominion Q1 miss sends LTL stocks lower. Anthony, this one hits me. So Old Dominion. Let's break down the numbers a little bit. They saw 11.2% less, or 11.9% less tonnage per day year over year, Q1 to Q2, or Q1 to Q1. They saw 9.6% less shipments per day. Both of these by themselves are not alarming, but together it means they shipped less freight. They moved less freight. So pounds per shipment, don't care. Revenue per hundredweight, it does tell me something when I see those miles not really moving significantly. So big takeaways here. Much less freight volume. As an LTL carrier, freight moves freight.
Yeah.
You have holes in these trucks, these spaces you have to fill. You're losing money if you do not fill them. Pickup and delivery runs, they have to have freight on them. For a 10% less volume, that is a knife in the throat to most LTL carriers. If you look at their operating ratio, they dropped from a 72.9 to a 73.4, meaning about half a cent less efficient on the dollar for every piece of freight they moved. On an 11% less freight, Anthony. The fact that their stock got punished and they were able to weather this storm, this environment, as well as they did, means that the financial hedge fund manager is playing fantasy football with your money. An 18% drop in value eroded away overnight based on this report. And arguably it could have been taken from some of the other signals that they were reading into. But from a pure analytics standpoint, financially speaking, there is absolutely nothing wrong with Old Dominion as a value.
This is where, when I first kind of got into the realm of, doing economic analysis and stuff like that, and I didn't understand at first when I first got in that realm of like what was already being baked into the market, what was being baked into expectations. And then, you start to see stories like this where, there are misses, but then you start to see what was baked into expectations after results come through.
Yeah, and that's, so what? This company did not lose any value from an efficiency standpoint. Maybe you can cite some debt or things like that. They eliminated 1,300 headcount over year. So they were managing through it aggressively. They were actually able to maintain rate increases because their revenue per shipment was still elevated, excluding fuel, by about 6%. So this is, I see nothing wrong with this on the financial side of things. Operationally speaking, there could be things there, but the shipments per day, everything there, all that operational data tells me that they managed this downturn as well as anybody could. If you look at some of these brokerages and what their operating ratios and their margins have done, their revenue has done, this is a poster child for success during a down environment. So some of the weaknesses of financial data, of course, are the fact that they only show high-level health. So Old Dominion, in this perspective, to me, their revenue was down, but they were operationally efficient. Mm-hmm. And we might be putting too much value on things like the revenue in this situation, especially when you're talking about the stock market value plummeting. If you know that the environment, the demand side environment, macroeconomically, is getting worse, you have no choice. That's not news.
Yeah.
That should have been baked into those expectations. Right. And would you disagree?
No.
No. Okay. So from my perspective, this company is financially, outside of revenue growth, in a great position because they've managed their costs and expenses underneath it. financial data is great at identifying where there's a problem and where there's not a problem. The only problem on this balance sheet was the revenue.
Right.
Everything else, or the income statement, was the revenue. Did you see anything else in these figures that made you concerned?
Not a lot of stuff jumped out for me.
Yeah.
For this report, there was another report that I thought was particularly interesting that John Kingston put out from C.H. Robinson.
Yeah, C.H. Robinson came out and had a worse
Yeah.
return. From my perspective, it was weak, and their stock didn't really drop. It was kind of like there.
Yeah.
So tell me, how does that make sense to you, Anthony? Where's the disconnect here? So down about C.H. Robinson, it had a better market for its LTL activities than truckload. Okay. Old Dominion's LTL.
Yeah.
Less than truckload. Gross profits were down 9.1% from a year ago on a 5% drop in volume and 4.5% drop in adjusted gross profit per order. So all down. However, they didn't get punished in the stock market.
Not at all.
Not at all. C.H. Robinson, largest brokerage in the United States, their volume is arguably their value. Total volume, they are volume, play in the market itself. They've laid off significant amounts of people, 1,500 people down versus the third quarter. So Old Dominion laid off 1,300 year over year. They're 1,500 down quarter over quarter.
Right.
Two different business models for sure. Very different business models at that. But same time, I want to pull up the NTIF here. So the NTIF is going to tell us where the spot market is predicted to move from this point in time. C.H. Robinson, of course, very exposed to spot market pressures going up or down. And it looks like, Anthony, we see a little bit of upward pressure from the forecast here. The blue line is the forecasted value for the next 28 days. The green line is the historical forecast. It's been missing a little bit more through the month of April. However, it did follow in line with that white line, which is the actual NTI value here over the last bit. So I don't know that I buy the strong upward move in spot rates. But the fact that there's any upward pressure at all, I think I keep stock in that leveling for a period of time.
Yeah, and there's been some really, I think, interesting charts that we've been seeing, that I've been seeing for sure within Sonar. One of the ones that kind of jump out to me as of late was some of the upward movement happening in the IOTI.
Yeah.
And that's going to be, of course, one of the things that's going to be a leading indicator for future surface demand here domestically. Starting to see some subtle movements upwards, not quite, I would say, like a complete trend shift just yet. But that increase, gets me a little bit interested as to seeing, okay, what's going to be coming up on the horizon. And really, I mean, when we're also thinking about what's already here, the inventories that we have already here, because we start thinking about the inventories that are already here in the U.S., we're hearing stories of, shippers and manufacturers working through inventories right now. And I'm curious, is it the right inventory that they're working through? Are they looking to make room for inventory that they know they're going to need at the really peak season that we get to towards the middle part of the year? So that's what really is starting to intrigue me right now.
Yeah, I mean, and the fact that the OTVI has shown such resilience in my mind over the last couple of months. I know these year-over-year figures are alarming. Yeah. And that's a flaw in looking at revenue. When you're looking at revenue, we've had record levels of inflation. That revenue does not mean the same thing. We saw Old Dominion. They had rate increases. So we actually propped up their revenue a little bit because they had rate increase. They got more for doing less, arguably. And the overall volume trend was too far down for revenue to overcome. But to me, we're in an environment now where people are struggling to figure out, okay, this second half recovery thing, how much validity do we have? Spot rates. Is there a theoretical bottom to the spot market and how low they can go? And some of the data is pointing to we may be at some level of floor.
Right.
So I think there is reason for optimism in the second half with the fact that we're seeing current environment not fall.
Yeah, I think that's Definitely a great point, because when you think about the first part of the conversation around Joe's article, there are some reasons for optimism for some of the shippers, for some of the carriers in the latter half of the year, while I think conversely, like you said, those shippers should be more concerned throughout the second half of the year. And definitely when it all comes down to, I think another big aspect of it all is going to be around the efficiency of it all. I mean, running efficient. You see that we still have excess capacity in the market right now. How efficient are some of these carriers going to be able to run as we start to get to some of that maybe potential inflection point?
Yeah, and we need the capacity correction to come into play for that to happen.
Right.
And that still hasn't really shown up
Right.
in the numbers. I'm looking at tender rejection rates. I'm looking at spot rates to see when that actually happens, because it's not just simply about how many trucks are there available. It's also about, are the trucks in the right spot?
Right.
And are they doing it for the right price?
And are they running empty?
Yeah, or they're running empty. And that is operational data that leads into that financial data. You know, I mean, I think too often we rely on the financial to tell the full story, and it does a good job in general, but it's not that actionable.
There's gaps.
It tells you where there's a problem. It doesn't tell you what the problem is.
And that's going to do it for the show. Oh.